As of the market close on Friday, June 12, 2026 at 4 p.m. Eastern Time, Plug Power stock settled at a price of $2.76 per share, marking a decline of 2.47% for the daily trading session. This downward movement occurred within an intraday trading range that saw a high of $2.91 and a low of $2.69, reflecting the classic volatility that has long defined this ticker. While a daily swing like this might look like standard noise for a speculative clean energy play, the real story right now is a subtle shift in how the company is managing its survival. Just days ago, management finalized a $39.2 million transfer of a federal investment tax credit related to its St. Gabriel hydrogen facility in Louisiana. This move follows a similar $30 million credit transfer earlier in the year. What this means is that instead of relying purely on expensive dilutive equity raises or high-interest debt, Plug Power is actively converting government incentives into immediate, non-dilutive liquidity to fund its day-to-day operations. This creates a fascinating tactical dynamic for anyone using a modern online investing framework, whether you track your equity through individual brokerage accounts on Interactive Brokers, use the SoFi trading platform, or manage complex allocations via Schwab Intelligent Portfolios. The common consensus surrounding Plug Power stock has always been binary. Skeptics view it as a perpetual cash-burning machine that survives on empty promises, while retail bulls often view it as a hyper-growth vehicle destined to dominate the future clean energy grid. The reality sits uncomfortably in the middle. The expectations of a sudden, effortless clean energy boom have consistently crashed against the hard reality of infrastructural delays, complex logistics, and severe capital constraints. However, dismissing the stock completely misses the operational tightening that has taken place over the last few quarters. Under the leadership of Chief Executive Officer Jose Luis Crespo, who stepped into the role earlier this year, the company has launched aggressive cost containment initiatives designed to stabilize its balance sheet. When you look at the macro picture, long-term trends show a significant recovery from previous multi-year lows, with the stock bouncing off its 52-week low of $1.03 to establish a stronger base, even though it remains well below its 52-week high of $4.58. This tension between historical structural weakness and recent operational stabilization is exactly what is driving massive trading volumes across retail and institutional platforms. If you analyze recent institutional activity, you notice that major self-investing accounts and wealth managers are handling this ticker with extreme caution, treating it as a tactical trading instrument rather than a buy-and-forget core asset. During the Friday session, trading volume reached nearly 50 million shares, keeping it among the more heavily traded names in the clean energy landscape. This heavy volume is a direct reaction to the company's recent first-quarter earnings report, which was released in mid-May. In that report, Plug Power managed an adjusted earnings per share loss of 8 cents, beating the consensus Wall Street estimate of a 10-cent loss. More importantly, net revenue grew by 22% year-over-year to reach $163.5 million. This top-line expansion was primarily driven by its Gen Eco proton exchange membrane electrolyzer product line, which saw equipment revenue surge significantly compared to the same period last year. Yet, despite these top-line improvements, the core problem remains a negative gross margin of 13% and a significant operational cash outflow of $150 million for the quarter. This brings us to the fundamental issue of liquidity strategy. For investors monitoring their portfolios on the Robinhood app or executing sophisticated trades through Interactive Brokers, the cash burn rate is the most critical metric on the screen. The company closed out the first quarter with roughly $223 million in unrestricted cash and cash equivalents, which represents a steep decline from its year-end figures. This limited cash runway explains why management is aggressively pursuing asset optimization. In addition to the recent investment tax credit monetization, the company executed a $132.5 million definitive agreement with Stream Data Centers as part of a larger infrastructure optimization program. These moves are designed to bridge the gap until the company can secure a massive, highly anticipated loan guarantee from the Department of Energy, which has been caught in regulatory due diligence for months. If you are balancing a portfolio across different asset classes, you know that missing an unexpected cash crunch can devastate an individual brokerage account, making these temporary liquidity injections a vital shield against sudden downside risks. Let us pause for a moment to consider where market participants stand on this clean energy narrative. Comment below how many shares of Plug Power stock you currently hold in your portfolio, and let me know if you are currently buying this dip or waiting for full profitability. To truly understand why the stock is behaving this way, we have to look closely at what Plug Power actually does. Based in Slingerlands, New York, the company builds an integrated hydrogen ecosystem that spans the entire life cycle of clean energy, including production, storage, delivery, and power generation.
Its commercial foundation was built on material handling, specifically providing hydrogen fuel cell systems for forklifts utilized in massive distribution centers operated by major retail giants. Over the past few years, the company has attempted to expand far beyond material handling into heavy-duty transportation, stationary power generation, and large-scale green hydrogen production plants. Its business model relies on selling the physical equipment, such as fuel cells and electrolyzers, while simultaneously locking customers into long-term service contracts and fuel delivery agreements. Historically, the fuel delivery segment has been a major financial headwind because the company had to buy hydrogen from third-party suppliers at high market prices and sell it to customers at fixed contractual rates. To fix the structural defect, Plug Power has been building out its own domestic production plants in Georgia, Tennessee, and Louisiana, aiming to achieve vertical integration and slash sourcing costs. This transition from an equipment distributor to a vertically integrated energy provider is the core driver behind the financial numbers reported in older quarters. Throughout 2025, the company faced severe operational challenges, including liquid hydrogen supply shortages that forced it to absorb massive losses just to keep its customers' material handling fleets running. These legacy issues triggered class action lawsuits and internal restructuring, forcing a complete overhaul of their pricing strategies and commercial contracts. Now, the company is attempting to prove that its capital-intensive investments are starting to pay off. The hydrogen fuel margins showed a notable improvement last quarter, gaining over 50 percentage points due to higher internal production volumes and fewer expensive third-party purchases. Furthermore, the company is deploying massive electrolyzer systems globally, including a recently completed 100-megawatt installation at a refinery in Portugal, alongside a massive 275-megawatt engineering contract in Canada. Looking forward, the investment thesis for Plug Power stock is defined by a massive gap between aggressive management targets and practical market risks. Chief Financial Officer Paul Middleton has publicly stated that the company expects second-quarter revenues to expand sequentially, with full-year revenue growth projected between 13% and 15%. Management maintains that the business will reach an inflection point for positive operating income by late 2027, with full net profitability targeted for 2028. For investors utilizing sophisticated online investing sites, these projections must be weighed against near-term macro realities. Higher-for-longer interest rates make capital-intensive infrastructure projects immensely expensive to finance, and any delays in government subsidies or Department of Energy loan closures could trigger further capital raises that dilute existing shareholders. If the company successfully scales its liquid hydrogen network and stabilizes its internal gross margins, the stock could easily outpace current analyst price targets. Conversely, if cash burn outpaces these creative tax credit sales, the market will likely punish the share price. In summary, the deep dive analysis of Plug Power stock reveals a classic conflict between an idealistic market narrative and cold operational execution. The public expectation focuses heavily on a clean energy transformation, yet the reality is governed entirely by cash runway and marginal unit economics. While the recent financial reports show clear signs of structural improvement, including reduced losses and innovative non-dilutive liquidity deals, the underlying cash burn means there is absolutely no room for operational error. Whether you manage your holdings through automated systems like Schwab Intelligent Portfolios, maintain active positions on Robinhood Investments, or analyze long-term options trends via individual brokerage platforms, keeping an eye on these specific liquidity milestones is essential. The company has proven it can grow its revenue and capture global contracts, but its ultimate survival depends entirely on its ability to turn green hydrogen into actual sustainable profit. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buyback sales. Don't forget to like, comment, and share this video to support the channel.